Hey everyone, and welcome back to the Babalian Money Show. Today we're diving deep into one of the most powerful tools in an investor's toolkit, the discounted free cash flow, or DCF model. Sounds complicated, right? Don't worry. My goal today is to break it down step by step, so that by the end of this video, you'll understand exactly how it works and how you can use it to estimate the true value of a company. Before we jump in, a quick disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. Investing involves risk, so always do your own research and consider consulting with a professional before making any investment decisions. Okay, with that out of the way, let's get started. So, what is DCF? At its core, the discounted free cash flow model is a valuation method used to estimate the value of an investment based on its expected future cash flows. The big idea is that a company's worth is the sum of all the money it can generate for its investors in the future. But here's the crucial part. Money in the future is worth less than money today. Think about it. If I offer you $100 today or $100 5 years from now, you'd take it today, right? You could invest it, earn interest, and have more than $100 in 5 years. This is called the time value of money, and it's the foundation of the DCF model. To perform a DCF analysis, we need to do a few things. First, we have to forecast a company's future free cash flow for a certain period, usually 5 to 10 years. Second, we need to calculate a discount rate, which represents the risk of that investment and the return we expect. Third, we use this discount rate to bring all those future cash flows back to their present-day value. And finally, we add all those present values together to get the company's estimated intrinsic value. Let's start with step 1, projecting free cash flow. What even is free cash flow, or FCF? It's the cash a company produces through its operations, minus the cost of its capital expenditures. Essentially, it's the cash left over after a company pays for everything it needs to maintain and grow its business. This is the cash that could be used to pay dividends, buy back shares, or pay down debt, all things that benefit shareholders. The formula for unlevered free cash flow, which is the most common type used in DCF, looks something like this. You start with earnings before interest and taxes, or EBIT. You multiply that by 1, the tax rate. Then, you add back non-cash charges like depreciation and amortization. After that, you subtract any changes in net working capital. And finally, you subtract capital expenditures, or CapEx. I know, that's a lot of jargon. Let's break it down with a simple hypothetical example. Imagine we're looking at a coffee shop called Morning Brew. To project its FCF, we'd look at its historical financial statements. We'd see how fast its revenue has been growing, what its profit margins look like, and how much it's been reinvesting into the business. Let's say Morning Brew has historically grown its revenue by 5% each year. We might assume it will continue to grow at that rate for the next 5 years. We'd then estimate its operating expenses to calculate its future EBIT. We'd apply a tax rate, say 25%, and then look at its past depreciation and capital expenditures to forecast those figures. It requires making some educated assumptions, and that's where the art of valuation comes in. You have to really understand the company and its industry to make reasonable projections. Once we have our projected free cash flow for each of the next, say, 5 years, we're ready for step 2, determining the discount rate. The discount rate is probably the most subjective part of the DCF model. It's meant to reflect the riskiness of the investment. A riskier company, like a small tech startup, will have a higher discount rate than a stable, established company like a major utility. A common way to calculate the discount rate is using the weighted average cost of capital, or WACC. The WACC calculates a company's cost of capital by proportionally weighing the cost of its debt and the cost of its equity. The formula is a bit intense, but conceptually, it's just blending the cost of borrowing money, the interest on its debt, with the return that shareholders expect for taking on the risk of owning the stock. For our Morning Brew coffee shop, if it has some debt and also has shareholders, we would calculate its WACC. Let's just say, for simplicity's sake, after running the numbers, we determine that the appropriate discount rate for Morning Brew is 10%. This 10% is the rate of return we need to compensate us for the risk of investing in this particular coffee shop. Now for step 3, the discounting part of discounted free cash flow. We take our projected free cash flows from step 1 and our discount rate from step 2 to find out what each of those future cash flows is worth today. The formula for this is present value equals future cash flow / 1 discount rate, raised to the power of the number of years. Let's go back to Morning Brew. Suppose we projected its free cash flow for year 1 to be $100,000, using our 10% discount rate. The present value of that cash flow is $100,000 divided by 1 plus 0.10 to the power of 1. That equals about $90,909. Now, what about the free cash flow in year 2? Let's say we projected it to be $105,000. Its present value would be $105,000 divided by 1.10 squared, which is about $86,777. We do this for all 5 years of our projection period. You can see that the further out the cash flow, the less it's worth in today's dollars because the denominator in our formula gets bigger. So we've discounted all our projected cash flows for the first 5 years. But what happens after that? A successful company doesn't just stop existing after 5 years. This brings us to a crucial part of the DCF model, the terminal value. The terminal value represents the value of all the company's free cash flows from the end of the projection period into perpetuity. We can't project cash flows forever, so we need a way to capture the value of the company in the long run. There are 2 common methods for this. The first is the Gordon growth model, or perpetuity growth method. This assumes the company will grow its free cash flow at a constant, stable rate forever. This growth rate should be conservative, typically around the long-term rate of inflation or economic growth, say 2 to 3%. You can't assume a company will grow at 10% forever. That's just not realistic. The second method is the exit multiple method. This assumes you sell the business at the end of the projection period. You would take the EBIT or EBITDA in the final year and multiply it by a valuation multiple, like the average EV/EBITDA multiple for similar companies in the industry. For our Morning Brew example, let's use the Gordon growth model. We'll assume that after year 5, its cash flows will grow at a steady 3% per year forever. The formula for terminal value is final year projected FCF asterisk 1 plus long-term growth rate / discount rate long-term growth rate. Once we calculate this terminal value, we also have to discount asterisk at asterisk back to its present value, just like we did with the other cash flows. So we divide the terminal value by 1 plus discount rate, raised to the power of 5, since it represents value starting at the end of year 5. Okay, deep breath. We're at the final step, putting it all together. We now have the present value of the free cash flow for year 1, year 2, year 3, year 4, and year 5. We also have the present value of our terminal value, which represents all the cash flows from year 6 onwards. To get the total enterprise value of the company, we simply add up all of these present values. The sum is our estimate of what the entire company, including its debt, is worth today based on its future cash-generating ability. But we're not quite done. That number is the enterprise value. If we want to find the value per share, which is what we can compare to the current stock price, we need to calculate the equity value. To do this, we take the enterprise value, subtract the company's total debt, and add back any cash on its balance sheet. The result is the total value attributable to shareholders. Finally, to get the intrinsic value per share, we take this equity value and divide it by the number of diluted shares outstanding. Voila! You have your DCF-derived price per share. Now you can compare this number to the company's current stock price. If your calculated intrinsic value is significantly higher than the market price, the stock might be undervalued. If it's lower, it might be overvalued. The DCF model is an incredibly powerful tool, but it's only as good as the assumptions you put into it. A small change in the discount rate or the long-term growth rate can have a huge impact on the final valuation. That's why it's often said that valuation is both an art and a science. The science is the math, but the art is making reasonable, well-researched assumptions about the future. It's always a good idea to run different scenarios, a best case, worst case, and base case, by tweaking your assumptions to see a range of possible values. This is called a sensitivity analysis. So, there you have it, a step-by-step guide to how the discounted free cash flow model works. From projecting free cash flow to choosing a discount rate, calculating a terminal value, and summing it all up to find the intrinsic value. It's a lot to take in, but I hope this breakdown has made it much clearer and less intimidating. Practice with a few companies you know, and you'll get the hang of it. Thank you so much for watching. If you found this video helpful and want to learn more about investing and personal finance, please hit that like button and make sure you're subscribed to the Babalian Money Show. Don't forget to ring the notification bell so you won't miss our next video. If you have any questions, drop them in the comments below. I'll do my best to answer them. Until next time, invest wisely.